So let's focus now more in detail on the documents that a company needs to provide to the market with financial accounting. The first document the company should design is what we call the balance sheet. The balance sheet describes the monetary value of assets and related rights, so equity and liabilities, in a given point of time, which is usually the end of each year. There are essentially two sections, so the assets and the liabilities, and the assets are all the items that includes the tangible and intangible resources which direct or indirect contribute to the financial flows or equivalent that will arrive to the company during that year, while liability include all the present obligation that the company has from the past and can result from transfer or use of assets, provision of service, or other yielding of economic benefits in the future. People that can owe liabilities can be internal, like as company shareholders, or external, like company stakeholders, suppliers, banks, and governments. Let's focus on assets. In terms of assets, we can distinguish between non-current assets, which are all the assets held for collection, trading, sale, or consumption going beyond the enterprise normal operating cycle, so a period of time which is higher than 12 months. Then we have current assets, which instead are assets held for collection, trading, sale, consumption within the enterprise normal operating cycle, so meaning the year or less than 12 months. Finally, we have what we call the assets classified as to be disposed, which includes all the current and non-current assets which will be disposed at the end of the normal operating cycle of the organization. So all the items that, all the assets that will no more part of the company after the current year. Then, if we switch on the balance sheet on the liabilities section, we can see that the categorization is similar because we have non-current liabilities, which are all the liabilities that are owned by external stakeholder and which will be claimed in the future, so after the current year. Current liabilities will instead include all the liabilities which will be claimed by stakeholders during this company operating cycle, and we have also, the section related to the shareholders' equity, where the company summarizes the value of liabilities and rights, which is direct property of its shareholders. Also here we have liabilities that will be disposed by the end of the company's operating cycle. That was for the balance sheet. Let's now switch the attention to the statement of income. The statement of income summarizes essentially revenue and cost coming from physical and financial transactions undertaken by the company in a given period of time, usually the current year. And as we already said, these economic flows are registered in the income statement using the accrual basic accounting principle. Here we can see an example of a statement of income from an oil and gas company, in particular Eni. The income statement first collects revenues and costs from operating activities, realizing what we call the operating profit. So the profit coming from operating activity, also known as earning before interest and taxes. Then income and expenses are recorded related to financial activities and investment, realizing what we call the profit income before income taxes. Then income and expenses are registered related to incoming taxation, realizing finally what we have what we have called as net profit. So the net profit of the company comes from registration of revenues and sales and costs coming from the operational activities of the companies, the financial activities of the company, as the regulation activities of the company. Please remember that under the accrual basis accounting, revenues are recognized in the annual income statement when product and services are in reality sold, namely they are out of warehouses for product or service delivered to the customer. Or even if they are not practically sold, risk and rewards of their ownership is transferred to the customer or to another economic subject, like for example when we transfer the insurance of the product or the service to be charged to the final customer, of course independently of the associated financial events of the payment of this of the product or the service. In a similar way, costs are included in the income statement when, the related product or service are sold, and so are the resources used to produce them, and this realize the concept called as cost of goods sold. Or when the related products or services are used or consumed for internal use. So when in these two cases, when these two cases are experienced, costs are included in the income statement. Again, also in this case, independently of when the financial events, meaning paying from a cash perspective, this cost will incur in time. In particular, there is we need to highlight a specification related to how costs related to the use of assets are included in the income statement. Because when an asset, which can be tangible or intangible, affect the company operations for more than 1 year, the cost of its acquisition and function is split during all of its life cycle. And each year, this rate is reported as a cost item in the income statement. This value and this logic is called depreciation when we are dealing with the tangible assets, or amortization when we are dealing with an intangible asset. So, example of tangible assets are plant, machineries, buildings, while intangible assets are like patent or are in research and development expenditure and so on. But we will analyze it more in detail in the next section. Finally, we have the cash flow statement. The cash flow statement summarizes all the results, so inflows and outflows of the financial transaction that have affected the company in a given period, so usually the current year. And can be this, we have two options to present the statement of cash flow. The direct, what we call the direct method, which is also the preferred method, with essentially sum all of the cash in positive and negative, grouping them by nature, or the indirect method, which instead starts from the net profit and adjusts the value of the net profit, switching from the economics perspective to the financial perspective, so adding and subtracting items that are related to the financial perspective but not related to the economic perspective. Let's see an example also for this case. First, but before doing that, let's summarize that in the cash flow statement, cash flow can be classified essentially in three categories. We have cash flows coming from operations, meaning all the financial flows related to the main revenue producing activities of the company. So all the cash flow coming from the executing operation, like procurement, like production, like distribution of the company. Then we have cash flow coming from investing activities, so all the cash flow coming from the financial investment or financial operation that the company is doing during a year. And finally, we have the cash flow coming from the financing activities. So all the cash coming from a company, from the activities incurred by a company when operating on equity capital, debts of the company, and when making financial investments. So cash flow coming from operation activities like as procurement, production, distribution. Cash flow coming from investing activities like acquisition or disposal of assets or other non-financial investments, and cash flow coming from financial investments, so investments that are not related to operation, like credit, debits, and equity movement. As I said before, let's try to see an example of this. So this is the cash flow statement of any, so coherently with the income statement we saw before. And here you can see an example of cash flow built by nature, so with direct method, with cash movement classified according to the distinction of cash flows as explained. We have here, you can see the cash flow generated from operating activities, the cash flow generated from investing activities like proceeds of disposal of property and plant and equipment, intangible assets, like payments on investment in property, plant and equipment, intangible assets, and so on. And if we go on, we have the cash flow coming from financial activities like dividends paid, operation with equity holders, cancellation of debtors and bonds, and so on. The final result of this document is the cash and equivalents cash at the end of the year, which is the final result coming from the cash flow statement. Here you see an example of instead a cash flow statement designed by with an indirect approach. And as you can see, we start from the results from the income statement, so the loss or profit for the financial year obtained by the income statement, and then you see that some adjustment needs to be made in order to subtract or sum movements that are not economic perspective related. However, the final result is always the net cash flows from operating activities in this case, because we were just considering the operating part, but of course we should be equivalent to the net cash flow from operating activity generated by the statement of cash flow designed with direct method. If we go on, here you can see that starting from this, we then subtract or sum events which are investment related, and we obtain the net cash flow from investing activities, and again we subtract and sum events from the financial activities, and we obtain the net cash flow used in financial activities. The final result then is the cash or the equivalence at the end of the financial year, which should of course be equivalent to the one obtained at the end of the cash flow statement designed with the direct method. Here you have the summary of all the financial reports which are relevant for financial accounting. So you see asset, and liabilities for the balance sheet, the income statement where the different sections are present, and the cash flow statement where the three different sections are present. Also, another interesting question, once we have in mind what does it mean, realizing report from financial accounting activities, an interesting question can be, starting from the analysis of financial report, which information can be drawn about the company? And in answering this question, we can say that starting from company financial accounting reports, we can do essentially two types of analysis. The first one is what we call the time series and cross-sectional analysis, which is essentially aimed to show relevant trends and relative weight of key items in annual report across time and industries. Then there is also, the ratio analysis, which instead try to analyze economic, liquidity, and asset indicator of a company. The ratio analysis is typical of an accounting course and mainly not possible with SAP ERP, as you need analytic tools. So, we don't go much in detail on this. Instead, we will focus on the time series analysis, which is instead possible through SAP ERP, as we can build reports which compare the same items in financial accounting documents across times. What does it mean doing a time series analysis? The objective of the time series analysis is compare key figure of a single company over a time period spanning from 3 to 10 years. Essentially, year by year, percentage variation of some items are highlighted in order to identify relevant trends, like stable increase or decrease of sales, of cost, and so on, and also isolate and identify how some events have impacted the variation of these items. Of course, it's not an analysis which is done just for analysis purposes, but comments are provided accordingly to the evidence provided by the numbers. Let's see an example. Let's consider, let's say, British Airways. Here you can see an example from British Airways financial reports cross-time analysis. As you can see, here the idea is considering the financial accounting documents in from 2009 to 2005, and summarizing the main financial accounting items, and their value is reported in this table. Then the next step is to calculate possible variation of this item across time, so stepping from one year to another, and of course you need to try to explain the main variation according to main economic and industry factors. Like, for example, British Airways in 2009 experienced a decrease in sales because of financial crisis and reduction of short-haul flights. Or again, it has experienced a liquidity reduction because of issue of convertible bonds for 350 50 million of pounds during August 2009, and so on. Or he has experienced a decrease in an increase of operating cash flow due to a revision of time collection of receivable and delay in payment of suppliers. This is, what we call the time series analysis, can then be converted in what we call the common size analysis or vertical analysis, which means essentially transform the previous number in intuitive graphs. It means identify and map the composition of the main categories of financial reports and analyze its components like operational cost, assets, and liabilities. It's easier to show you instead of explaining this, but you can easily understand that from these graphs. As you can see in these graphs, this is, the breakdown of cost for each year. For each year, 2009 to 2005, each cost item, let's say realizing the cost structure of British Airways, so other accommodation, handling charges, landing fees, engineering, foreign and oil cost, depreciation, employee cost, is calculated as a percentage, is expressed as a percentage of the total cost structure. In order to, let the reader understand its incidence on the total. In our example, in particular, we can see that fuel and oil cost, this part of the graph, and employee cost, this part of the graph, are the two cost items that most impacts the British Airways income statement on the cost side. Of course, you can do the same for asset and liabilities or everything you can think of. In this case, we can see that for asset, for example, non-current assets are the items which are predominant in this category. See that up to 77% of the total value of asset, as well as non-current liabilities are predominant for the equity and liabilities section with an average of 45% of incidence. We can, deep dive on this and try to analyze how total non-current liabilities are composed, and in particular we can see that of this value of total non-current liabilities, most of them related to long-term debts, which are represented by this area. So of these 45% of total liabilities, up to 70% is for interest-bearing long-term borrowing, so long-term debt with the bank. Of course, the final step is, opening our perspective, also considering other companies. So by now we have only reason in terms of single company perspective. Common size analysis, which is usually, when it is usually done on a single years, can be performed on a cross-sectional basis. So comparing set of similar companies. In this case, in the case of British Airways, for example, we can compare the same indexes with Lufthansa, with EasyJet, with American Airlines, and so on.